Yeah, so we all know that artificial intelligence and blockchain are among the most hyped technologies being marketed to asset managers. But should the wealth management industry invest in these technologies, and what are some of the things that they're most concerned about? With us to discuss these issues are Shaun, Chief Investment Officer at Nutmeg, Dann, Bibas, founder of Fountain, and Dann Tammas-Hastings, founder of RiskSave. Just feel free to jump in if you have questions at any point, but I'll also save 10 minutes at the end. I was going to ask Ishmael to start off by explaining what blockchain is, but since he can't be with us, who's the best, Dan or Dan?
I think that Dan.
I think this Dan is going to walk out right now.
Could you just start us off by explaining what blockchain is and artificial intelligence, and specifically what application it has in wealth management?
Shall I do artificial intelligence?
We're more AI than blockchain. So maybe we can...
Okay, blockchain, Dan, closest to me.
So blockchain actually doesn't have much to do with our company in particular, but an area, I guess, where blockchain is relevant to us is actually our audience of millennials, people in their 20s and 30s, are actually beginning to look at Bitcoin more and more. So, for example, we had a focus group the other week that someone actually said to them a diversified portfolio in 5 or 10 years will have an element of alternative currencies and Bitcoins and Ethereum. So I don't think I could provide you an exact definition of blockchain because we're not exactly a blockchain company, but it is definitely something that we're keeping an eye on as a budding wealth tech company.
Okay, and why? Why are you keeping an eye on it?
Again, so I guess, so to give everyone an idea about Fountain, so we're going to be launching in a few months. What we are is essentially a goal-based investment platform. What we've realized is to make investing simpler and more relatable, you have to realize, okay, why do people want to invest? And most people would tell us, well, investing sounds good, but there's no shortage of tube adverts talking about an ISA or a lifetime ISA. What people want is they say, I want my money to grow towards a first home, I want to pay for my wedding, I want to travel, I want a rainy day fund. So we've kind of reverse engineered this like consumer appetite. And then essentially, so as part of our proposition, it's extremely important that we know what our users want. And like I said, why is Bitcoin on our radar? It's again because I think if you speak to someone maybe in their 50s or 60s and you ask them, what is a diversified portfolio to you today? In the UK, it would be like, I don't know, 95% property, or no. That wouldn't be very diversified. It would be, property, it would be some equity, some bonds, some cash. Whereas when you speak to people in their 20s and 30s, we hear this over and over again that they say, what if there could be like a small allocation of a diversified portfolio? What if that were a 1% into a basket or just Bitcoin or Ethereum or different currencies? I wouldn't be surprised if in a few years, investors in their 20s and 30s almost look at Bitcoin or Ethereum as an alternative to gold in case of financial crisis or some kind of geopolitical risk. So that's why alternative currencies like Bitcoin and Ethereum are definitely on our radar.
Yeah. I think it's possibly quite important to separate blockchain technology or distributed ledger technology, as they keep on rebranding it, from Bitcoin and the cryptocurrencies. What we're seeing is a lot of interest from banks and asset managers, and they're all generating patterns in using blockchain-based databases to share information. Whereas I think cryptocurrencies is a bit more of a speculative, not necessarily bubble, but it's quite frothy, and people are very interested in making money out of it. But I say it's speculation, not investment, because as the previous speaker said, investment comes from creating sustainable wealth. Whereas what we're seeing in cryptocurrencies is people basically extracting wealth from the system without necessarily producing anything.
Yeah, I mean, there's a difference between Bitcoin as an asset class and blockchain as a technology. And I guess one of the things maybe you can explain, Dan, is what is machine learning to a wealth manager? How can they use it?
Well, I think machine learning in many ways is useful, I think mainly on the onboarding and the user experience, but can also be useful in investment. And I try and separate investment into asset allocation and the actual execution. How do you execute trades? Because AI is a very big part of a lot of high-frequency trading hedge funds. People like Man Group and Winton use AI for their trading strategies. But these are all high-frequency tradings that aren't actually necessarily that useful for us direct to retail.
And why not?
Essentially, if you are managing a portfolio of funds and you're not trying to outperform the market, or you're trying to get roughly market performance, your turnover ratio should be maybe once every 6 months, or just a rebalancing process. Whereas the high-frequency traders are trading their portfolio over maybe once a week. And ultimately, due to MiFID II and other regulations, we need to show our costs and expenses. And yes, if I was turning over my portfolio once a week, it would be very difficult from an execution perspective. I might make a little bit more money, but then actually on the risk report that goes to institutional investors who I'm targeting, it will suddenly look like I'm generating 3% costs, and I'm generating an extra 20 basis points of profit, and it's not really the market we were looking for.
Shaun, as Chief Investment Officer of one of the largest digital wealth managers, are you investing in or currently using machine learning technology?
Yes, so we've got machine learning projects across every department in Nutmeg. So to give you some examples of things that are live, within the onboarding process from the last 2.5 years, we've used machine learning to improve our KYC AML pass rate, so moving from low 90% up to 99%. It's been a very effective way of scalping more data to improve that pass rate, which is, as a business, that improving the funnel is very important to us. So that's been very effective. Also, with our commercial team, we use machine learning and neural networks system that we've developed in-house to really improve our conversion, using different channels, data from different channels, understanding that customer consideration period and how we should spend and where we should spend to acquire the right customers. That's really helped us. That's been in place over the last year, and not surprisingly, we've doubled our customer numbers and lowered our cost of acquisition quite substantially over the last year. So that's been running very successfully for us in kind of the commercial team. Across the whole business, we run FedEx days on a very regular basis. So you've got 24 hours to design, build, and ship something, and a huge amount of those projects are around AI and machine learning. So it's becoming much more integrated within our business. We recently took the decision to carve out all our data people across different departments into one data team, really run by our data scientists, so a lot of PhDs, and exploring how we use all our data. So if you imagine 5 years of live managing money in the wild with customers, 47,000 customers now, that's a huge amount of data. Data around behavior, data around customer characteristics. We're really mining that data lake to understand customer behavior. And as Daniel mentioned earlier, we've been predicting customer behavior for more than 3 years to really understand how people behave, particularly around drawdown. So there was a comment earlier that we haven't really seen a big drawdown. Actually, we have. Last 5 years, there was a 24% drawdown peak to trough in the FTSE All Share. We've been through that. The guys that have been obviously launched in the last 18 months haven't really seen that. So we've been using a lot of predictive data to understand and predict customer behavior during that drawdown. It's only really useful when markets are going down. So that's stuff that's very automated and will really reignite when markets start going down. So for us, the real win is predicting customer behavior, getting the right comms out, monitoring the effectiveness of that, and then really building on that. And that really does require a lot of data, but also a lot of machine learning techniques to really interpret that data. And
what's the hope for an older wealth manager, one that's established itself in a previous way in a previous time, and what's the hope for one of those businesses to kind of to integrate data analysis in that way?
I mean, there's obviously the big elephant in the room is GDPR coming in May, so that's one of the big incentives for these big incumbents to really sort out their data and really have a good handle on one data source that they really own and control, and it's very well managed with the right systems and controls. So they need to do some of this anyway, but I think for incumbents, actually having the real grasp of your data and thinking of that as a value and as a technique is very, very important, but very, very difficult. In some ways, you probably need to reinvent your whole platform to think about data in that way. So, naturally, Nutmeg, we started with a clean sheet of paper, cloud-based from day one, very much thinking about data from day one. So we've built our whole business gradually with this in mind. So I think it's quite hard for an incumbent to reinvent the business and think about data, but to really understand customers in the future digitally, you need that data interpretation.
Just to give a sense of the scale, how many data scientists do you employ?
Across the business, it's only about 4 out of a workforce of 100. So quite small at the moment, but I expect that to expand quite significantly. Within my investment team, I've got 3 people that already have experience in machine learning.
What kind of experience?
For example, using machine learning to select hedge funds based on return profile data. So some different industries, people coming from power, for example, people coming from hedge funds, people coming from chemical industry, people who use a lot of data in their day-to-day work, I think are quite useful to bring into the investment field who haven't come from the investment world, but are bringing different techniques, particularly around data and machine learning.
Mm-hmm. And Dan, can you just talk us through some of your own experience developing Fountain and how you've utilized machine learning?
Yeah, sure. So obviously machine learning has like one obvious restriction is that you're only as effective as the data you're sitting on. So if it's ready, organized, and in abundance, then you'll have a much easier time, which is back to the point about, what do older asset managers do? Yes, they have to rebuild a slate from scratch, but at least they do have access to a lot of data, whereas startups usually have this opportunity to build really great technology from the ground up, but essentially you start with zero data. So one thing that we're working on and we've tested in a closed environment is essentially we're very much so a fintech company, but we really focus on our consumers, and it's more a consumer problem that we're solving than a fintech problem. And one thing that we've tested in a closed environment is actually through chatbots is to have conversations and interactions with potential users. What we do there is essentially collect data on all the questions, all the uncertainties. You'd be surprised how, again, all the adverts that are out there in the world explaining stocks and shares ISA, but still it's probably one of the most common questions. And you essentially build these data.
What's the question?
Like people ask, just what's an ISA, or like what's the stocks, what's my limit for stocks? And there's like ample evidence, ample like, and I'm sure Nutmeg, you guys probably get that question like.
Yeah, I mean we've
on
got
repeat.
we've got a whole ISA center, but you still get half of your calls
Exactly.
and about what's an ISA.
So based on that, you can, and the data that you collect, and again, I guess on the topic of AI, not to throw in another buzzword, but chatbots are actually quite handy because the best way to learn from your users, especially as an early stage startup, I think is still just speaking to them and having those conversations. But naturally, a founder wants to have those conversations, maybe another staff. You can't really do it on scale. With chatbots, you actually can do it on scale. You can have very high frequency and high volume of interactions with your audience and understand like what are their uncertainties. Why do so many people not understand what a stocks and shares ISA? Is it confusing, or is it just it hasn't been explained properly? It's never been made relatable. So in terms of machine learning, we really look at creating these large data sets to really understand like what are the almost pain points or needs of our customers and identify patterns and essentially build a platform that will solve these needs and address these concerns.
And is the idea to get younger people, or is it to get people who don't want to spend so much money? Is it about cost consciousness? Or
So I'd say we, in particular, target millennials or people in their 20s and 30s. And again, similar to what Wealthified mentioned, it is a bit of a longer game because naturally you're accumulating less assets at a younger age, but you hope that with time they're the people that have essentially the higher paying jobs. And also there are other macro data to show that millennials will actually benefit from the largest transfer of wealth in history. So that's again a very macro trend that might take 8 to 10 years to play off. So we cater very much so to, we don't really like to call millennials, but like the smartphone generation, just because we think various technologies like a chatbot can be very good at onboarding because I mean, we all have a good form, but eventually past, a minute, you just want to log out, whereas a chatbot is much more interactive. And for that technology is really right for people that already live on their smartphones. So to answer your question, it really is people in their 20s and 30s that are very, I guess, mobile or tech friendly.
Are most people here from the wealth management industry or from technology companies? Can you raise your hand if you work in wealth management in some form? And technology? I see. Okay. Yeah, I mean, I guess of the people who work in wealth management, can you raise your hands if you feel like millennials will respond better to automated chatbots? And if you think that they won't, and actually they just want to be taken out for a fancy dinner by their parents' wealth manager. Interesting. Okay.
I do think, though, on that topic, like, not all millennials are the same. So if you have someone who is 30 and a multimillionaire has very complex financial needs, probably a chatbot or financial service like ours that really aims to cater to the masses is not suitable. They might need something a bit more bespoke, at least where we are now in terms of technology. But for someone who is a few years into their career, has disposable income, maybe paying the hefty fees isn't so suitable. So I think no two millennials are the same, and there are a lot of different needs out there.
I think when it comes to chatbots, they just have to be so good. You have to get the right answer. Yeah, we've got those running in-house, and they just have to be perfect because people will lose patience with them very quickly. We find chat a very useful channel, particularly for our customers that work in the city.
Do you know
they don't have time to email or call, but they're quite happy to chat if they can speak to a real person. Now, you can improve that, and you can get a chatbot answering it if they feel they're getting the right answer, but it still won't stop people ringing up and saying, have I done this right? Getting that comfort factor from speaking to a person, which is still very important for Nutmeg. That's why we have a lot of people that are there to talk to people through.
I was going to say, the thing with chatbots is a lot, unless they're very, very complex, they are just scripts, and it's often you find you go off script virtually immediately, and then you've got a person involved and a slightly annoyed customer. So actually, at this an early stage in development, it can actually be counterproductive. But what we're seeing in technology is Google, Apple, and Amazon are spending a fortune on things like Alexa and Siri. Yeah. And I think actually, hopefully at some stage, they'll be able to license technology like that to us, and we can tailor it in-house.
I mean, it's already open source, so we've already got that running, but that kind of thing is open source, it's easy to run, but then you encounter other things like security. So great, very simple to mock up, and we had lots of people build these things, but then you get to the hub of it. It's actually, can you talk to Alexa in a secure environment and get into your Nutmeg portfolio and ask Alexa what's been happening during the day? Very easy for us to do that, but how do you overcome some of these hurdles around security? So how's that person logged into that Alexa? Is it a neighbour talking to Alexa? I'm sure we've all done it. We've actually been accidentally talking to Alexa when we haven't meant to talk to Alexa. There are some of these practical real-world challenges. So it's actually pretty easy to build a lot of this stuff. You know, if you've got the data, you can open source, cloud-based, the hardware's there, very easy, very cheap to use, but you come to the practical implementation, particularly around systems controls, regulation, and security. That's when the real kind of rubber hits the road. So that's when you need to do a lot of testing with customers and to get these things really right. It's not just that pure technology piece.
I'm conscious of time, so Dan, can we just quickly, do you want to talk to us a bit about whether or not artificial intelligence can be used in asset allocation before we move to questions?
Yeah, sure. So I have been a big fan of artificial intelligence for execution, implementing trades, for making sure that you get the best possible fill. When I was at Merrill Lynch, we used systems that were what would be considered virtually AI now, but were actually what was then called statistical arbitrage. But where I am slightly sceptical, although I think this will change, is in the asset allocation process. What we've seen generally is that whenever you get overconfident in technology, things generally go wrong and you get a crisis. So in the 90s, EM was considered great. In 2005, 2006, we had the growth of quantitative hedge funds, statistical arbitrage trades, and obviously the credit bubble. So we had very, very complex black box models that no one really understood at firms like GSAM, and we had models that people did understand but weren't correct, that they had confidence in at Standard & Poor's and Moody's. And because of an overconfidence in models, we developed the biggest crisis we've ever seen. And what I'm slightly worried about is in 10 years' time, if we have another crisis, it should be larger than the one before, because ultimately the size of the crisis is related to the amount of credit in the system, and the credit in the system has never been bigger. So if we have these overconfident models, what's going to happen? And I'm not sure.
But can't you design a model so it's not overconfident?
Well, the problem is with data, because when you have an AI system, you put loads of data in it, and the quality of the data gets you the better AI. But the reality is we've not been to a situation like this before. We haven't had interest rates at zero for 5 years. We haven't had this massive expansion of credit. We're in completely uncharted territory. And I don't necessarily see how an AI system that relies on back data can ever predict the future from that.
Do you think this is a question for regulators, though, or does it mean that? Are you saying that we won't get returns, or is it something that needs to be regulated?
I think the regulators are on top of this. They have the Financial Policy Committee at the Bank of England that looks at systemic risk, and it's something they are aware of, but it's not at the top of their system. The top of their system is high-frequency trading hedge funds, which they are now less worried about. And I think the main worry is actually how much debt is out there and the way that pensions regulation forces companies and individuals to buy debt when yields get lower.
But you're saying that automating the investment process would add to that risk?
Yes, because it should lead to more concentration. And also it will lead to worse risk management, because the risk manager won't necessarily understand the black box or the algorithm. Now, if I was to design an algorithm myself, it might not be as good as an AI. But ultimately, if there was a crisis, I would be able to risk manage it better because I'd understand the factors and the inputs. Whereas if we have this AI system that's been developed, it's run for 2 or 3 years, it's had astounding returns, and then something strange happens, something that's never happened before. Maybe the S&P drops 50% overnight. That's something that's possible. What does the AI do? Does it panic? Do we know? Do we understand that? And that's something that I would very, very much worry about. And for me, I think it's important, at least for the next 5 years, that the regulator doesn't allow massive concentrated risk in AI strategies.
Why only for the next 5 years?
Well, because maybe by then we'll be understanding AI better and then we'll look at it again. But I mean, if say, a relatively small part of the market, if a fintech fund was running $1 billion, 2 billion, 3 billion, 5 billion, hopefully it's one of us running 10 billion, that'd be fantastic. That wouldn't actually contribute to systemic risk. But as fintech gets embraced by legacy players, if we suddenly see someone like Legal & General with $1 trillion under management, most of it based in the UK, we have this massive concentration of risk that's not understood by the regulator or the investor, and certainly not by the end user, and definitely not by the government. And I think that would be quite dangerous.
So I mean, I agree with lots of what Dan said. I think that
It was a bit depressing, I'm
no,
sorry.
it wasn't. In our business, I think the investment side is probably the least promising out of all the areas because of that need to have control and understand what's going on in your model. I think when it comes to investment, if you look ahead 3 to 5 years, the toolkit for asset allocations is going to completely change. So we're very reliant on economic statistics, monthly survey, some weekly data. That toolkit hasn't changed in the last 25 years when I've been asset allocating for 25 years. It's still the same. We still rely on pretty much the same indicators. But when you think about Internet of Things with that big data, there's going to be a huge amount of toolkit of data sets available for us to buy in the next 3 to 5 years that give us real-time insights. So to give you a good example, Siemens MindSphere, 30 million industrial devices, control units that Siemens have around the world, that can be hooked up to the internet, to the cloud for €900, each single device. Imagine all those control units reporting real-time. Basically, you have a real-time global industrial production tracker. Give you huge amounts of data. Monthly statistics are completely irrelevant after that. So these data sets will be expensive to buy, but I think they'll be your standard toolkit for everyone that's doing asset allocation in the next 3 to 5 years. Maybe it's sooner than that. But that's where we use the tools. We won't say, here's an AI system, let it run the process. We'll use parts where we can still have control.
So, yeah, before we run out of time, does anyone have any questions? Yes.
You mentioned AI for onboarding with the bot. You mentioned AI for asset allocation. One of the things that I think has been talked about within digital wealth management is AI to do risk assessment, capacity for loss, and that kind of assessment going in. So, which is the right portfolio? Everybody lies. So when they say, what's your capacity for loss? Oh, it's fine. Well, actually, as soon as it drops 10%, try and sell everything. How many pints do you drink a week? Oh, it's definitely only 4, but actually probably close to 16. So how, I think Nick, before he left Nutmeg, he was talking about sort of bank account scrubbing, seeing buying and selling habits, trying to get a really good picture. Is anyone using that kind of level of AI to kind of do that?
So I would say that already on just simple data analysis, we're already getting those behavioural insights because we collect a huge amount of information about risk, behaviour. We can monitor real-time behaviour of customers. That already gives you simple data analysis, give you really good insights in predicting behaviour. When you start scalping other data, whether it's from social, whether it's from bank account, that can give you an added layer of predictability. So I think we'll move away from this annual risk assessment of capacity loss. It's very much annual process to more of a real-time insight on people's capacity loss. That does bring you other challenges because we know that risk behaviour, capacity loss changes over time, maybe changes by day basis depending on what's going on in your life. But I think we'll move away from this kind of very standardised risk assessment to more of a real-time insight that gives people a real good indication of how they're behaving and how we can help them stop behaving in those ways which are detrimental to long-term wealth.
Any more questions? Yeah.
How about the artificial intelligence in research? I think it might be disruption that is coming up. What's your view on that?
Sorry, I can't quite hear.
Yeah, can you repeat that question?
Is there a mic?
What is your view on the disruption that is happening in the investment research market, and what are the AI solutions that are coming right now?
Is that the disruption due to MiFID II?
Yes.
It's difficult to know. So MiFID II is really complicated. It means that it means that if you're a US fund manager, you're not allowed to pay for research. If you're a European fund manager, you do have to pay for research. And the SEC and the European Union have kindly said that they're keeping an eye on it, but not which of the laws you should obey. So far, the disruption we've seen is just small independent shops setting up and the larger managers trying to work out how much their research is worth and what to pay for it. But I personally haven't seen any AI input into that as of yet. So which is not a great answer, but...
That's okay, we have really a solution for that side.
That's good.
Anyone else? Yeah, you and...
Does it worry you that you're all using the same data, the same similar algorithm, the same things? When you look at some of the situations, say you look at Reinhardt on the IMF website, which is how you roll savings to pay out national debt. coming to?
Well, I'm using a very different portfolio allocation methodology from other robo-advisors. We was founded by fixed income specialists 2 years ago, and we use an LDI solution, which is a liability-driven investment framework, which matches people's asset liability management needs better and more closely than the standard solution. So we moved beyond ETFs to an individual stock solution. But I think what you're saying is there herding? Is there concentration problems?
How are you going to prove that 100,000 lemons can't be wrong?
Or I think that's more of a regulatory issue than a commercial issue for us. And the main systemic risk and issue like that, which I alluded to earlier, is caused by the government's pension regulations and how pension funds are forced to invest in long-dated bonds as and when the government decides. And we have this thing now where in the last 5 years we've had a very strong bull market where the FTSE's gone up between 10 and 15% every year with very little volatility. Now that should be great for pension funds and investors, but during that entire time period we've actually seen pension fund deficits balloon. And this is because of regulation, and there's not anything that we as commercial money managers can do about that, I'm afraid.
I think that was a question. Do you have a question?
Yeah, I was just going to ask about the AI, and you mentioned sort of different parts of the process that play into within the company. Is it predominantly developed in-house, or do you go out to your supply chains, give it work with to say, right, how can I adapt that to mine? Wondering how much is developed from yourselves, and then how much is from the network of companies that help you run your business?
I would say it depends on your business how much you outsource. So we insource most of our suppliers. So we had a process earlier on when we first set up. We had a lot of third-party suppliers to get us going, and we realised after 18 months that wasn't scalable. Every kind of 18 months, 2 years, you reinvent yourself because you have to, different scale problems. So it comes down to really where is the data and who owns the data. So for our AML, KYC, we're scalping in data from the credit agency. So that lends itself to a third-party solution. When it comes to customer behaviour, it's our data, and we own that data, and it's very important to us. So it's our solution. But it's the technology, the hardware, the cloud is very cheap and very easy to get. Most of it free. So it's the data. Data is the real value there.
Yeah, we're very specialised in focusing on just the investment process and the risk management process. So everything else we outsource. So that's where our AI comes in, and the main use of it at the moment is KYC.
I think I agree kind of spot on with what Shaun said. Especially at an early stage, there are a lot of tools, outsourcing options to make the most of sort of these nascent AI capacities. But with time, you definitely want to be in a position where you own more and more of the customer experience. So if you own more of that customer experience, you need to kind of own the customer data to detect, understand patterns, understand customer needs. So I guess you could start by outsourcing, but I think you'd be wise to work towards a more in-house solution as you grow.
Maybe one last question from
So one of the challenges for the wealth management industry to deliver good long-term outcomes for consumers is getting the asset allocation right and then having the safer stick with that through event risk. How do you think the depersonal but precise rule-based AI advice to a consumer versus the personal sort of face-to-face reassuring human touch is going to play out when the asset allocation hits the unexpected? I.e., are you going to think people are more reassured by AI and the science behind that, or good old Charles with a nice shirt who's reassured from where they should invest?
I would say they're complementary, and there's different layers. So we do use a lot of automated parts of the in-app experience to help customers and understand. So we can see from behaviour, we know when you're close to churning, close to saying, I've had enough of this, I'm a first-time investor, I've lost this amount in my first month. We can tell from behaviour when people are going to do that. So we can communicate very early to them and really educate customers. That doesn't always work, but you can go on to other layers. So there are interventions and stages of intervention where you have automated services which eventually lead to a phone call. And we've been running that for 3 years. So if customers are not responding to the interventions, we'll give them a call. Now, obviously, that brings scale issues around that, and that's where more of the AI comes in. So I think as more people trust this, it will enable us to scale even more. But ultimately, there will still be people involved. There will still be the Charles, as you put it, that will help people in that situation. So I think this is enable us to scale the wealth management service to a greater number of people. So essentially it's still the same service, but it's going from offline to online.
Okay, I think we have to leave it there, but thanks very much.
Thank you.